I don't know about carpenter, but if you've got kitchens and stuff, he can do that kind of thing, right?
Okay, everybody, welcome back. It's great to see all the networking going on, and it's sometimes a hard pull to get everybody away from that. But we've got a great speaker coming up, Ron Smith, another member of our group with House to Home Mortgage Group. So I'm just going to pass it over to Ron. He's going to talk to you about strategic lending placement.
Thanks, Joe, and thanks everyone. Welcome. We got lots to cover today, so I want to just jump right into it actually. As you know, the seminar topic is called Strategic Lender Placement. I'm going to give you some more information about that in a minute, just so you know exactly what you're in for today. But I thought before I did that I should introduce myself. As Joe said, my name is Ron Smith. I'm the Managing Director for House to Home Mortgage. I'm a licensed mortgage broker, also a real estate investment advisor, and like most of you, I'm also a real estate investor. So I'll explain a little bit of my journey as well sometime today and give you some insights into what I'm working on right now. House to Home Mortgage is an Alberta-based mortgage firm. We're a newer firm within the last year. We specialize in residential mortgages specifically for first-time home buyers, refinance, renewal, credit repair, and financial foundations. And what we're here today to talk about, real estate investors. So this is definitely a passion of mine, as we'll talk about throughout my presentation. And I really feel I could be a valuable service for you as you go through your investment journey as well. So, and what do we do? I should probably tell you that. We actually act as an intermediary between those who have money and those who need it. And sometimes those who have money and those who need it are actually the same person or the same group. And we work with all of the major banks, alternative lenders, non-traditional, and we're going to talk about that later in our presentation as well. So what are we going to cover? Well, just doing a brief overview of the Canadian banking system as it relates specifically to lending. We're also going to talk about the rules for strategic lender placement, which is important for us to cover today. Real estate wealth building blocks, which again many of you know already and some of you are actually doing today, but I just want to give everybody a good overview of what those look like. We're also going to provide some examples, have a time for questions and answers, and I do have some free things for our audience here on site today. So everybody's going to be walking away with something, hopefully not just information. Always a good thing. Okay, so today we're talking about access to capital through strategic lender placement. So it's kind of a fancy name. Some of you may not even understand what it is, just because it's something that we don't talk about all the time. But it's nothing really more complicated than just being very intentional about when and in what order we access capital for our real estate investment projects. And I know typically whenever we, as homeowners, we look at getting financing for our own principal residence, the default usually is to go to our local bank, the ones we've been dealing with, that we have checking accounts with, etc. Or if we know a mortgage broker, then we may contact that person and get the ball rolling. And what normally happens in the world of investment is basically the same process takes place. Kind of the default for most people is to start with their bank, and then depending on what the bank has to say, we then take some extra steps. What strategic lender placement is basically is to do that either different or sometimes even upside down or backward than what you normally would, to make sure that you don't get capped too early in your investment acquisition process, because a lot of times the banks have certain conditions that would prevent you from achieving the goals that you've set out for yourself as an investor. So we really want to approach this strategically, and that's what we're going to talk about in detail today. But before I do that, I actually want to kind of back up a little bit. Actually, we're going to back up 2 bits. And just give you a bit of a disclaimer. So in Alberta, I am licensed with the Real Estate Council of Alberta, RECA. I'm also a member of the Alberta Mortgage Brokers Association, AMBA, and as such, that makes me a licensed mortgage associate. So I work with Mortgage Alliance, as you can see down here, and I provide feedback, advice, and my expertise to those who are looking for mortgages. We're going to cover a lot of different information today. So I just want you to know very clearly that I'm not an accountant. I'm not a tax attorney. I'm not a lawyer actually of any kind, but I do have some really neat practical experience that I'm hoping will actually feed into your story today. But everything I'm sharing is my opinions, my experience, my own journey through knowledge and attending seminars just like this to acquire information I didn't have before. But you really do need to talk to your own mortgage broker, your own lawyer, your own accountant to make sure that some of the strategies we talk about today actually make sense for you. And I believe that most of them will today. So is that fair? Can we all agree that that's where we're at? Okay.
Or use you as a broker.
Or use me as a broker, exactly. Well, on that note, I really truly do want to be your mortgage broker of choice. So either in this session or afterwards, I'm happy to chat with each one of you and talk about that as well. So let's kick into the Canadian banking overview. So again, I don't want to go back to economics 101, but I do think it's important that you understand kind of how the banking system works. So I'm going to give you a Coles Notes version of this. Essentially in Canada, our interest rates are determined by the Bank of Canada based on the value of our bond as a country. And they typically do it through this thing called a 5-year bond yield. So the better the country is doing, the higher the bond yield is, usually. The worse the country's doing, the worse the bond yield is. So what ends up happening is the Bank of Canada sets their rates, the prime rate, we've heard that. Some of us have heard the overnight target rate, which is essentially the amount, the percentage of interest that the government basically tells the lenders, like the large banks, that they can actually use whenever they're lending to each other, because believe it or not, banks actually lend to one another regularly, and that's done typically overnight, and that's why they call it the overnight bank rate. So the overnight target rate truly does dictate the prime rate. And I'm sure some of you have been following this last year. We've actually had a number of prime rate increases, which from an investment perspective definitely taps into our ROI. What some of you may not realize is that prior to this year, and whenever the rates all started to move up, the Bank of Canada held their rate for like almost 7 years. So we have been in this really neat little place, and maybe almost too comfortable of a place, because realistically, over that amount of time, the banks should have increased their rates more than they did, theoretically. So now we're kind of paying for it, so to speak, but the economy is moving up, which is great to see and great to hear, but as such, the rates are looking good, and subsequently, the prime rates are moving up. All things being equal, without getting into the whole economics of it, I hear from all the people that I follow that we're still going to see at least 1, if not 2 more bank increases. So depending on where you're at with your portfolio, if you're looking at doing some refinancing, or there's a project that you're waiting to pull the trigger on, this probably would be a really good time. We just had a rate increase on the 24th of October. We're looking at doing one sometime near the end of this year in December when the next increase comes about, and maybe 1 more in the new year, and then things are probably going to stay static, I'm hearing, until after the federal election. But again, it's anybody's guess because these things do change quite often. Last but not least, I just wanted to mention CMHC. We're going to talk about them in a quick second, so I'll jump over that one for now. So one of the resources I'd like to leave you with today, and I would highly encourage that you go to this and bookmark it and check this on a regular basis, is mortgagedashboard.ca. So everything I told you basically exists. This is just a snapshot of or a screenshot of a very small part of their website, but they do actually cover the 5-year yield. And as you can see, this is from January of this year. It kind of goes up and down and all around, but it actually is an excellent way to look at the trends of the interest rates and whether they're moving up and moving down. And from my perspective, I do use this for clients, especially ones that are thinking about doing some refinancing. That number, as it shifts up and down, we definitely want to secure their pre-approval or approval during a time whenever the bond is dumped a little bit, so that we can get a better rate long term. But there's some fantastic resources on there. Also, Canada Mortgage and Housing Corporation is another place I would definitely look. They've got some amazing resources for both people buying and selling houses. The reason it's appropriate for you guys today is because CMHC literally has billions of dollars to invest in real estate in Canada through people like us by different programs that they have in place. Sometimes it's for new homeowners, sometimes it's for new to Canada, but definitely you want to spend a little bit of time on CMHC and check out what they do and how they do it. So why do I need to know this? Well, some of you may say, well, I don't need to know this, and others may say, no, you don't need to know this, I'll take care of this for you. And if you do have a good realtor, good mortgage broker, good lawyer, that could be partially true. But I feel that nobody cares about my money more than I do, so it's important that I actually educate myself so at least I understand the rules. I may not need to know them inside out and backwards. Not everybody needs to become a mortgage broker or a realtor to buy and sell real estate, but I do think it's important to have a good overview of how this stuff works, because it truly is your money, and you want to make sure that you are protecting it with the knowledge that you actually can acquire. And that's my pitch for that today. So let's actually talk about some of the rules. So strategic lender placement rule number 1 is essentially avoid being told no in the first place. Now, why this is an important rule is because a lot of times, as I mentioned earlier, we think, okay, our bank is going to be the very first person that we talk to, and they're going to be the ones that, of course, want to do business with us. We've been banking with them for 20 years. I've got an RRSP and an RESP, and I buy cookies at their bake sale every now and then. Of course, they're going to want to give me money to buy properties. But what we're actually seeing more and more all the time is that that's actually not necessarily the case with all major banks. And over time, they are definitely, and as we're seeing now in this kind of economic period we're in right now, they are being very, very selective with how they lend out their money. Even to regular first-time home buyers or regular refinance clients looking for either buying a principal residence or refinancing that, we're actually finding that there's been some resistance from the major banks. A lot of that has to do with what you've probably heard called the stress test, which was rules that changed earlier this year. That's definitely changed the playing field a lot, and tons and tons of people have their homes up for renewal right now, and many of them are finding that how they used to qualify is no longer how they need to qualify today, and if they haven't been careful with the way that they've been accessing capital and making sure their credit reports are looking good, they're actually having a difficult time and may even have to leave their bank to go into alternate lending sources. So we won't cover it on that side today, but just know that from a real estate investment side, it's no different. And actually, in some cases, it's even more difficult to access capital because of the way that the banks have been tightening up their rules, with just us as homeowners and our principal residents. So be aware of that. So what does this mean to you? It means that you don't want to get a no your first time out. So there's a very good chance the bank is not your best first time out. You want to have a strategic plan in place so that you know when the bank actually fits into your strategic financing plan, because it may not be your very first best step in this process. So in some cases we've heard that banks have a policy where they'll only allow you to have 1, maybe 2 rentals over and above your principal residence. Some of the major banks go up to as high as 5, just kind of in a standard, somewhat conventional financing arrangement with you using your resources. And in a lot of cases, that's where you as an investor would be capped unless you're using some other more strategic investment sources or financing sources. So we'll cover that in a little bit, but just hold on to that thought for a few minutes. So strategic lender placement rule number 2 is maximize your lowest cost capital first. So that may sound contradictory at first, because we typically know, especially as investors, that if we're actually talking to private capital partners or maybe hard money lenders, we're likely going to be paying a higher interest rate, and in some cases higher fees, because there is a lot of times lending fees that go along with that, having access to that money. But that's why having a strategy in place is critically important. And I'm not talking a strategy for the next 30 days or 60 days or 90 days, because even with fix and flips and RTOs and some of the other strategies, rent to own that is, people may be looking at a shorter time frame, but at the end of the day, you need to make sure that your strategic plan actually lasts much longer than that. 1 year, 3 years, 5 years, even longer, so that you can basically look at your cost of capital and you can position different strategies within that, let's call it 10-year window, so that you're actually not paying more capital costs than you need to. And in some cases, folks think that, okay, I want a low interest rate, so let's just throw out a number of 4%. So my interest rate is 4%, and I have to pay for an appraisal or some other its and bits. So whenever somebody comes to the table with, as a private lender, well, I'm going to charge you 10% plus a 1% lending fee, people, like, whoa, like that's crazy, because I can get this other one at 4%. Why would I ever pay, that much more money to get access to that same amount of capital? But again, depending on what your project looks like, if you need to sell that project within 3 to 6 months, and there's a prepayment penalty, for example, or the interest rate whenever you're doing apple-to-apple comparison with the major banks, that actually may be a much higher rate of return, or a much higher interest rate than what it is through their posted rates or the initial conversations you have with one of their in-branch lenders. So it's critically important that you basically work out those numbers. That's definitely where I come in as part of my services, is I help you to work out what your lowest cost of capital is. And in some cases, I will recommend that you do talk to a hard money lender, or you do talk to a joint venture partner who may be charging you 10% interest. But if it's a means to an end for a 3 to 6 a month fix and flip, that might make a lot more sense than getting a traditional mortgage, even an open variable rate mortgage with prepayment penalties that you would then have to pay $2,000, $3,000, $4,000, $5,000 in penalties, depending on the amount of the mortgage, which actually may be a lot more than what your cost of capital is by paying a higher fee up front. So just be aware of that. Number 3, protect the relationship with your lending partners. So this basically goes across the board, because what you want to be very, very mindful of is that this is a marathon, not a sprint. So there are definitely people who make money in the short term with real estate and can make a lot of money. It can definitely be a lucrative business. But if you are truly a real estate investor for the long haul, and not just somebody who wants to churn some cash and get out of the industry, you really do need to protect the partnerships that you have, even with people you're not doing business with yet. I always look at every relationship as a future partnership, and every lending person as a lending partner. So you're actually going to hear me use that phrase a lot today, because I truly believe that your lenders are partners. And whether they're your major bank partner, whether they're your hard money lender partner, these are all people who are helping to facilitate your success by accessing their capital for whatever duration of time that you need it. And that's critically important. So, going back to our earlier conversation about our bank, and I'm not picking on them, that's just, they seem to be a somewhat easy target. You walk into your local branch, you're very excited to do business with them, they flatly tell you, nope, you're just, we don't want to lend money to you for real estate purposes. You want to be gracious and thank them for their time, knowing that maybe in 6 months or 2 years, whenever your portfolio has built, maybe now you have a small portfolio that you can actually get a blanket mortgage to cover all of those properties, whatever it may be, you want to be able to go back into that same branch and have a conversation that's going to look different for you the second time around than it did the first time, and you want to make sure that you maintain those relationships. And just on a side note, it's the soft people skills in this business that I really truly think make the difference between an amateur investor and a seasoned investor. And I'm saying that because even an amateur investor can have 10 properties and no people skills, versus a seasoned investor who may have 1 or 2 properties and is exceptionally good in business and dealing with this kind of stuff. Because our tenants are our partners, our lending people are our partners, our mortgage broker, our realtor, people in this group, we're all partners to one degree or another, and we're here to help and support one another in whatever that may be, which is truly how I think partnership exists. So, a strategic lender placement rule number 4 is prepare yourself for endless opportunities. So I'll share my story in a few minutes about how I actually became a mortgage broker, but I'll just give you a snapshot of what's to come. This was the reason that I became a mortgage broker, because I very quickly looked at the real estate investment sphere, I guess, whenever I was considering becoming involved as a professional real estate investor, and I realized that access to capital was going to be the one thing that prevented me from building a portfolio to the size that I had envisioned that it would become. So whenever I put unlimited capital together with unlimited opportunity, that's where I said to myself, okay, that's where I need to fit in. Because again, opportunities, especially with people like this, in rooms like this, they come up all of the time. And if we're able to strategically prepare for those opportunities, knowing that this isn't just a short-term exercise, those opportunities will come up more and more over the course of the time that you're involved with these types of communities. And again, Street Smart REI is an excellent one because we are all investors, or very close to becoming investors if we have nothing in the market right now. So just be aware of that because it is very important. Also, being able to act quickly on opportunities is a key part of this as well. And that's why you need to spend some time just preparing for it. And that's why having a relationship with your banker, having a mortgage broker who is investor focused, having a realtor who is investor focused, and knowing that you also have a lawyer and some other people on the back end, property manager, property appraiser, that are all in this to help support you in your acquisition of rental properties or investment properties. That's why this becomes so important to be part of. So, a little bit about my story. As I said earlier, I'm the managing director of House to Home Mortgage. Long story short, whenever I first realized a little over a year ago that I wanted to spend the rest of my life in the real estate industry, I didn't really know exactly what that meant at the time. I actually became a landlord the week after I turned 16, believe it or not, when my biological father passed away unexpectedly and left me 2 small houses and a farm in rural northern Alberta. And as you can appreciate, as a 16-year-old, there was a lot of other things I was thinking about, not how to collect rent from my tenants or what on earth is a sewer backup or whatever it may be. And even though it was a trial by fire period of my life, the lessons that I learned through that time have stayed with me my entire life. I was the only 16-year-old who had a will amongst my group. I entered my first renovation project at the tender age of 17 when I actually hired my buddy's 15-year-old brother to paint the outside of this house that I had. So again, that would have been an awesome reality TV show back then. But at the end of the day, I had some really interesting experiences early on. Have since, probably like many of you, when you first bought your first house and moved through that journey, have bought and sold many of my own principal residences, have been a landlord, definitely know how to paint and tile and all the other stuff that I don't necessarily want to do today, but you learn these things over time. So anyway, I'm off track. So whenever I decided I really wanted to kind of rekindle that passion for real estate and spend time in this industry forever as a profession, that's whenever I said to myself, again, I need to have access to unlimited capital if I'm going to have access to unlimited opportunity. But the goal was never to become a mortgage broker, even though I really like what I do and I find myself quite good at it. I, like you, want to be an investor. So literally on the same day that I incorporated House to Home, I also incorporated La Scala Capital Investments. Because again, like many of you, I realized that there's basically 2 sides to real estate. There's the active side, which is more on the House to Home, where we're basically involved with deals on a regular basis. And then there's more of the passive side, where we're lending money to others who are out there doing deals. Now, I'm not showing you this to plug my business. I'm showing this because even whenever I first started my journey in this a little over a year ago, I was very strategic about what steps I was taking in order to achieve my ultimate goal, which was, in our case, my family's case, multifamily properties. That's our end game and will continue to be unless something radically changes in our journey. So I would encourage you, make sure that you have your end goal in place. Not everybody needs to become a mortgage broker, please don't. Not everybody needs to become a realtor, maybe please don't either, I'm not sure. But if you feel the desire to do that, then do that. There are some phenomenal courses out there. Again, Yarrick has done a great job with Street Smart to get tons and tons of resources. So figure out where your sweet spot is at. And even today, it's very inspirational listening to the other speakers and knowing that, okay, some are experts in rent-to-own, others are experts using RRSPs, others do renovations and fixes and flips. Like there's so many ways to do it in this industry that it's amazing. So just know where you're at, where you're going, and make sure that you execute that strategy as you go forward. So, fair? Have I covered some good grounds there? Okay, thank you. Thank you, Garrick. All right, so now we're going to talk about the wealth building blocks. So as I just chatted about, the essence of wealth building blocks can be kind of summarized in 3 different points. And that is, understand your goal, plan/prepare, and then lastly, execute. Because one of the things that I find about certain communities in the world of real estate, and I'm part of many of them, just for the record, because I find that I get excited about this type of community, and it's good for business too, just on the side note, full transparency. A lot of people come to these things and don't do anything with the information. And there's kind of a group of people that now over this last year I've seen at basically every different event that I go to. And I know that they're gathering information, which is good, but I also kind of get the sense that they're really not going to be doing anything with this information regardless of how much they get it. So I would encourage you to make sure that you're actually utilizing building blocks of wealth and use real estate as that mechanism that will actually generate wealth for you and your family, either short term, depending on your strategy, or long term, depending on your strategy. So here are the blocks. First one, pretty straightforward, it's quick cash. So this one basically is when we involve ourselves with flips, rent to own, even wholesaling, assignments and joint ventures. Wholesaling is one of those things, and assignments I just want to park on for a moment, only because for investors that have little or no capital, but just a lot of energy and a lot of connections, this is a fantastic way to enter the market, where you basically, through proper legal channels, you tie up a property for a certain window of time, and then you go out and get other people to help you to close that deal. And that's where joint venture partnering comes in, and or even rent to own or flips. So you can make a phenomenally good income short term in this real estate industry without putting up much, if any, of your capital, but you will have to put up some of your time if you don't have the capital. Ultimately, it's good if you have both, but I don't know about you, there never seems to be enough time or enough money kind of all at the same time. But that's a great way to build cash, quick cash, through building block number one. Building block number two is when we start to get a bit more kind of intentional with the longer term period, like we've heard even with one of our speakers today, and that's through cash flow. Now I know that for the new folks watching or listening, whenever people say cash flow or a cash flowing property, they normally mean that the income minus the expenses of that property is actually equaling something positive. So just because I've been in business most of my life, I like to call it positive cash flow. And there is such a thing as negative cash flow. So if you hear cash flowing, think of it as positive cash flow. If people don't talk about it, that means they're losing money. So let's just not talk about their cash flow. But you can actually lose money in a project as well on a monthly basis. Now the caveat to that being, there are times when it actually makes a lot of sense to lose money on a monthly basis with a property. We don't have time to cover that today, and I'm not encouraging you to go out and do it as a regular part of your business, but just know that as part of your strategic placement strategies, you may actually have to have a loss for a certain period of time in order to get a gain at another time. But anyway, cash flow here, when I'm talking about positive cash flows, things like rental properties, of course, rent to own is another fantastic strategy. Multifamily, definitely, which is actually interesting. Multifamily most attracted me in my very early days in this journey because the property itself was considered a business entity on its own. So if you have a multifamily property and you're looking at buying one, most multifamily properties would not be listed for sale if they were actually losing money. It's like, putting up your local Subway or car dealership up for sale and knowing that every month you're actually not making enough money. And I've been in business since I was 15, so I understand essentially you want more money coming in than going out, and whatever's left is kind of yours to keep. And that's where I really personally enjoy the multifamily side of things. And of course there's commercial as well, which again, for new folks to this, sometimes people actually call commercial and multifamily kind of the same thing. In this scope, I'm talking about like a strip mall or building something that actually has commercial applications, not just commercial lending, which can fall under the multifamily properties as well. And last but not least, building block number three. This is probably one of the most exciting sides of things. Oops, sorry. This is where portfolio income truly becomes your long-term cash money machine, essentially, because you're now able to use the results of your hard work to be very, very passively involved with real estate. Now, some people are able to become passive investors right from the get-go because of other occupations they've had, or wealth accumulation that they've had over the course of their lifetime, maybe an inheritance, whatever it may be. So it doesn't always have to come through real estate, but a lot of times it does, because real estate is an excellent place to park money, and typically if you do any of the studies or listen to Warren Buffett and other guys, they know that true generational wealth is typically passed on through real estate holdings, not necessarily through other things. Sometimes, but not always. So this is when you basically get to be the banker. And I'll show you a slide in a second where we actually have a resource for you guys today as well. But you can actually borrow money to make money. So even in a situation that I'm in right now, I'm actually a hard money lender on one project where I've actually taken money out of my HELOC at 4.5%. I'm lending that out at 12%. The difference between those two numbers is mine to keep, minus whatever the government will get based on my income on that amount. But that's a great way to do it as well, depending on how much you have access to capital. And as we also heard earlier today, self-directed RRSPs, LIRAs, TFSAs, those are becoming an amazing way for people to leverage what in some cases is negative returns on their stock and investment portfolios into a long-term capital play within real estate. So, I won't tease you any longer. This is a free ebook that I'm offering everybody today here live, and also that follows up with this recording later on. It's a book called You Can Be the Bank. So this is where you can maximize your real estate return on investment with little or no effort. And both myself and my mortgage mentor, Claire Drage, have contributed to this book. And it basically gives people the opportunity to learn more about how they can actually be strategic with their income and or savings in order to actually passively invest in real estate, which can also be a strategic play whenever it actually comes to real estate investing. So, going back to your plan, this is something that only you know and only you can determine, but you do need to figure out what your long-term play in real estate is. Some people like to get in quickly and get out quickly, and that's okay if that's what you are wanting to do. But I would definitely encourage you to think about real estate being a lot more, as I said, a marathon than a sprint. Because it's hard to get a good understanding of all of the stuff that you will hear and see and learn about, especially in your early days of this journey, to be a savvy investor. And even, it happens almost daily where I'm sitting with somebody, and I consider myself having a very good foundation of this and have done many of the strategies that I talk about, but I learn something from every single investor I sit down with. And even, as I said yesterday, I had a conversation with a guy who literally blew my mind with some of the things that he had talked about that he did 10 years ago. And I'm thinking, wow, I just learned about that like last week. So, you just got to be mindful of that. And whether you're in it for the long run or not, I really think it's important that you do step into this space, considering that what you do is a business. Because it really truly is. This is not a hobby or a pastime. You're messing with people's lives here. Tenants are, again, one of your top customers. You want to treat them well and fairly, and you want to be good to them and make sure that your properties are good, safe home choices for them. You want to work, obviously, with lenders, whether it's your big banks or some other mono lines, alternative lenders, hard money lenders, etc. You want to make sure that you're creating a good reputation for yourself as you're actually doing this. Now, with that all being said, there's a lot of people out there, like the vast majority of real estate investors, who may only have 1 or 2 properties. So if that's where you fit, that's okay too. Don't think you have to build, a real estate empire to be considered seriously. Just the fact that you've actually have another property or 2, I mean, congrats for that, because most Canadians don't have that. You're already in a select group whenever you've actually taken that step. So, the thing that we need to talk about for a little while now is your path of least resistance. And this is where we're going to talk a bit more specifically about some of the things that you should be considering as you're going through your, especially your initial days of trying to figure out how you're going to access capital. So, most people, whenever they hear this is your path of least resistance, typically the first thing they think of is visiting their branch. That's just kind of what happens. There's, bank branches all over the place, so I'm just going to head into my branch and I'm going to have a conversation with them because that's the easiest thing for me to do. I would disagree with that strategy only because of some of the stuff we talked about before and some of the things we're going to talk about now, because I think it's very The banking world has changed dramatically over the last number of years. And I was just recounting a story a couple of days ago. My mom and dad lived in a small town, and up until even about 10 years ago, I was literally able to pick up the phone from Calgary, call one of the people that I knew and grew up with in my hometown, and we could do banking transactions over the phone with my word as the anchor to that conversation. That does not happen any longer. And as much as I love banks, I mean, I am a banking customer, I have bank accounts for both my personal accounts and my business accounts, the chances of me making a meaningful relationship in a bank is pretty much over. Those days just don't seem to happen anymore. Especially with technology and automation and so much of it just being driven by numbers and scores. To have a face-to-face conversation with somebody about your situation, both as just a regular bank customer, let alone an investor, those conversations have changed dramatically over the last few years. So I'll share one quick story about a client of mine earlier this year that kind of had this conversation with their branch, and I'll give you the Coles Notes versions of it because it was a few-week process. But people that I knew I was involved in the mortgage industry, wanted to take some money out of their home in order to buy a recreation property. Their house was paid off, very secure a job, both of them, good credit, just all around good, decent people. So they had been dealing with one of the large banks for many years, 40 years actually, they ended up finding out. And like many others, thought, you know what, we're going to go and talk to our branch to see, this should be just a signature, and I'm going to get this rental or this recreation property. So they started that process, went in and talked to somebody at the front line. I don't know about this bank, but the people that I talked to at my bank, they're actually called a level 1. So they're like literally they're the first level, like level 1. They do they set up bank accounts. They help with if you need to buy a car or get a GIC. Like that's kind of where their specialty is. They do mortgages from time to time, but only if they're that real kind of simple vanilla mortgage, I call it. Anything outside the box becomes complicated according to their lingo. So if you're self-employed or if you're an investor wanting to buy an investment property, you would now become a complicated file. Anyway, my clients were none of those things. Just boring, plain, vanilla people, awesome people, and all they wanted to do is take up some of the capital, not most of it, just a percentage of it, from their primary residence. So they went in, the person that they sat with immediately suggested a HELOC, a home equity line of credit, which at first glance, not a bad idea, I guess, except it was at 3.9% interest. So again, here's folks with AAA credit, tons of equity, buying a really nice property that had value in it as well, and that was kind of the best that they could do. So they called me and said, hey, just came from the bank, this is what they said, would you be able to do something better? And without even knowing all of the situation, I said, absolutely I can. To process that story quickly, I ended up getting a 2.65% mortgage, which was the very best choice for them based on all of their needs. And they thought that was great, but were a little disappointed that their bank didn't offer them a similar product. So the gentleman in this conversation said, you know what, I feel that I need to go back to the branch and tell them what you're doing for us, and then give them a chance to see if they can kind of help with that. So at first glance, I'm like, no, don't do that. But I good people, good friends, I want to save people money, so I'm like, you know what, that's a great idea. Go do that, and then let me know what they have to say. Not only did they did drop their price from 3.9%. The short end of the story is they actually couldn't match my 2.65% rate, and these clients ended up actually using me as their mortgage broker to buy the recreational property. Now that's not all that surprising, and that's like not a revolutionary story at this moment in time, but let me give you the background. The 2.65% mortgage I was able to get them was with the same branch that they were actually doing business with. And whenever they heard that I was able to get them 2.65%, again, the gentleman, he went in, I made it sound like he went in nicely, he did not. He said, you told me 3.9%, you better match this 2.65% or else we're going with Ron. The bank manager was involved, the level 1 person was involved, they came back with a 2.9% counter. And he said, no, you're not listening, 2.65, do this, you've got my business. Do anything else, I'm going with Ron. And again, it worked out for me and them that they ended up going with me. So my point to that long story is essentially this: things have changed in the world of banking. And the path of least resistance definitely is no longer the least resistant, it seems, because the way that the rules and just the systems around banking has actually changed. So let's actually talk a little bit about lending partners, because that's important to actually know who they are. There's many out there, and we don't have time to cover this in great detail, but if you want to chat with me later, by all means let me know. So the kind of the first level, the first tier is major banks and financial institutions. These are the guys that advertise heavily, that you see on many street corners. Within Alberta, there's a number of local ones as well, like ATB, Service Credit Union, Bow Valley Credit Union. That's kind of where they all fit. Then there's the Alt-A-B lenders, and that's essentially the ones that are for folks that are, maybe not exactly at that kind of AAA level with the banks, or just want a better option, like what I found for my clients. That's kind of where they sit. Then whenever we have folks that are kind of fitting outside those boxes even further, like self-employed, which is they call business for self in the mortgage world, or they have bruised credit, they actually then would move into something like the non-traditional or subprime space. After that is where things kind of, I don't want to call it the Wild West, because I don't see a lot of craziness going on, but this is where things start to change typically as far as how the rules go with kind of your average investor. And that is private investment funds and or joint venture partners, and then hard money lenders. There's no hard and fast rules to what I'm about to say, but typically a private investor and a / joint venture partner, this would be a situation where if, let's say somebody found a fantastic deal on a home and they wanted to buy that house, renovate it, and then hold it for a period of time, but they didn't have the cash to do kind of any of that, they would then talk to a private investor, they would make an agreement, always make an agreement in writing with a lawyer for agreements like this, and they would basically say, look, I found the deal, you've got the cash, let's put those two things together, and then we're going to make some money. At the end of this, we're going to split the money. A lot of times that split is 50-50. So the joint venture partner who found the deal and the joint venture partner who's funding the deal basically get the same return. That's not hard and fast, but that seems to be kind of the general convention of things. Hard money lender is a little different. Same kind of story, but somebody finds a property, let's say, and knows that they can make a ton of money, or they can use their own skills as a painter or a plumber or whatever. So all they actually need is a bit of money to kind of pull the trigger, so they can do all of that themselves and don't necessarily want to be working with anybody else. They kind of want to do this on their own. They don't really want a long-term partner. They just want somebody who can actually get them going and get them the cash they need to close the deal. That's where a hard money lender goes. Typically, just so you know, I think this graph shows it next. Yeah. Major banks and financial institutes typically have the lowest interest and the lowest fees. As we keep moving to the right, the interest rate goes up typically, and fees either kick in or else they ramp up dramatically. For both private lenders and hard money lenders, as I mentioned earlier, there's typically always a lending fee of some sort, which again isn't a bad thing as long as it fulfills the parameters of what you're looking for with your capital costs. But what ends up happening most of the time, which I find very interesting actually, for the more savvy investor, well actually let me back up a step. For most of us as homeowners, these are kind of the steps that we would take whenever we're looking to buy our own principal residence. We start with the bank, we move to alternative if things aren't quite right, and then we go down the list. I very rarely hear of anybody buying a principal residence with hard money lenders. It does happen from time to time. Private lenders, though, joint venture partners, is kind of essentially what the rent-to-own space is. Like that's kind of where that sits. So it does happen regularly where people are buying homes with private lender funds. But what happens in the world of true investment is, and with savvy investors, is this arrow diagram almost reverses. Where as a strategic lending, or as an investor looking for strategic lending solutions, you may actually start with a hard money lender or a private lender and then work your way back. And as we actually talk about this topic today, that is really what I'm hoping to convey to you strongly, is that you do not likely want to start with some of the regular lending partners. You want to see if you can kind of hold them off to sometime in the future when it actually makes sense for you to go in, as I mentioned earlier, and do like a blanket mortgage over 10 properties. Because a lot of times these folks, in the first two categories, they will actually stop your growth with 1, 2, 3, maybe even 5 properties. Sometimes there are some alternative mortgage lenders who will actually lend you a larger amount of money, even some cases, let's say up to $2 million, but then you're capped. So then you have to kind of go back and figure out, okay, how am I going to move pieces in and amongst this so it actually facilitates your end goal? And what I try to do with clients is I try to get you guys to a point where the only cap that you have is your own capacity to make sure that you can actually handle the workflow and the activity that comes with buying, maintaining, and managing your investment portfolio. If you're an active investor and are doing your own property management, for example, and maybe your own tenant screening, et cetera, you know, this can be a very, very busy time to do all those kind of things, especially if you're working in another job or have other outside activities. Whereas the more passive side is where then you can become, you know, more on the lending side and let somebody else look after all of the details. You can still own the property, you would just hire companies to look after all of those details so you didn't need to worry about it. So, out of all that list, who do you think you need to be the most strategic with? Any idea? Well, the answer is the major banks. And mostly because they are the most strategic partner in all of that mix. Banks are very, very strategic with what they do. And it's important to know that somewhere in the mix, you definitely want to use one of the major banks or multiple major banks in some instances to fund certain stages of your real estate acquisition strategy, but you need to go into this kind of thinking already. Even if you have no properties right now, you want to think, okay, what is the order? Who do I talk to and in what way? So we don't have time to talk about strategies with all of them, but I did want to cover the one with the major banks to start with, because this is probably the ones that, again, we're the most familiar with, and this is kind of default for most, you know, non-strategic investors to go to first in order to get things going. So I want to talk to you a little bit about the banking calendar, bank personnel, individual banking limits, what they look for, and then questions that need to have answered. So the bank calendar is an interesting one. No, this isn't the calendar that they used to send you at Christmas. They cut that out because they'd rather have profit than you have a calendar. This is basically the way of the year of a bank, so to speak. Many of you don't know this. I didn't know this until I got into this business full time, that the bank calendar actually ends at the end of October. So from November 1st to October 31st every year, that's the bank calendar year. So picture this. 2017 was a killer year in the banking industry. They made more money even with the downturn than I think they made in a number of years. So again, imagine yourself going into a branch the middle of October of last year, thinking, okay, you know, I've done the courses, I've hung out with Yarrick, I've been to, you know, some of these events, I am ready to buy my first property. So let's say over the summer you did some looking around, and let's say you actually found something that you thought was really cool. And after a little bit of back and forth, you kind of thought, you know what, I'm ready to do this. Then September came, and if you have kids, you know what that's like. So September was a wash, just trying to get schedules back in place and your kids going where they're supposed to be and your own life necessarily back on track. And then came October. So now you're walking into a branch after you called and made an appointment. It's the middle of the month. You want to access capital. Well, you walk in typically to the branch and you're dealing with, again, usually level 1, maybe level 2 personnel that really don't understand the complexities of mortgages, maybe don't even quite understand the whole stress test thing. And I'm not saying they don't, because there's some phenomenal people in branches, so don't get me wrong, I'm not picking on them. But there's some depth there that just doesn't always happen at that first level or second level. And then they're already thinking, you know what, we've had a killer year, my year is done. So sure, I want to talk to these people, and you know, yes, they're clients, and I want to be respectful, you know, as a representative of the branch, but they know that they've already got a bonus. They're trying to figure out what they're going to do for Christmas vacation, and your needs may not be on the top of their list at this particular time. So again, whenever we work with clients who are wanting to, or because of our strategy, needing to go talk to the branch, we direct them to the branch, and we have a strategy that we use to make sure that they're actually going to the branch, you know, not in the middle of October if you can help it, And at certain times, certain dates, just to make sure that you're positioning yourself in the best favorable way so that you can actually to make that happen. So I also mentioned just briefly a bit ago about bank personnel, and again, I'm not here to pick on anybody, but whenever I opened up my bank accounts last year, the person I was sitting with said, well, what are you doing? I'm like, well, I'm a mortgage broker and real estate investor. So that tweaked her interest. I'm like, oh wow, I don't get to do that much of that at this branch. So tell me more. So we chatted about it for a little while, and then I said to her, I said, well, tell me about you. Do you do a lot of mortgages? How about investments? If I wanted to buy a property, would you and your branch be interested in chatting with me? So we chatted a little bit about declared income was the very first thing. She says, well, you'd be self-employed, right? I'm like, yeah. And she asked me a few more questions that went along with that. And then she kind of laughed and said, you're actually a complicated file. That's her exact words. You're a complicated file. I'm like, oh, so what happens with complicated files? She says, oh, we send those to head office. So, we would send that information to them, they would contact you, and they would call you and talk about your complicated file. Well, I'm 50. I'm married to a wife who works. I have excellent credit. I have money in the bank. I have equity in my home. Yes, now I'm a mortgage broker because that's the decision strategically that I made for my life. So yes, my income isn't every 2 weeks and doesn't come to me on a T4 from another corporation. It comes from me, from my corporation, but now I'm complicated. So I thought, wow, isn't that interesting? Because I'm a good customer, and I'm a good risk. Both my wife and I are. But sometimes within that world, it's not. It doesn't fit the certain boxes that they actually need to make it work. Now, with that said, of course I wasn't going to follow up and make an application. So, the process may have been really good for me dealing with their complicated file department, and they may have approved me for exactly what I wanted. But again, knowing what I know about the banking system and knowing that, if I was to get enough cash from them to get 1 or 2 properties, chances are, once I hit that 3 or 4 mark, they'd be holding me back because I wasn't able to fill some of their other boxes whenever I was building the portfolio. And that's actually where individual bank limits come in. There is no rhyme or reason to the limits of the banks. And one of the things I have to say, which I thought was very interesting when I actually first became a mortgage broker and really kind of engrossed myself in this information, banks, actually all lenders, on the financial institution side of things, they can change their lending requirements, or not requirements, their lending interest almost at the drop of a hat. So 1 month, and I'll just use Royal Bank for example. 1 month, Royal Bank may say, you know what, we really want to target new to Canada with income under $100,000 combined income for first-time properties with 5% down. That's kind of that's the thing, for example. And that might be what they're doing. Fast forward a month or 2 later, they go, whoa, we've already got enough business from that, or we've filled our bucket, so to speak, or our bucket is now full of all of those people. No more new to Canada. We don't want to even talk to immigrants anymore. Now we want, business for self. So we want people who are self-employed, Canadian permanent residency, have been in business for themselves for 2 years, da 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 da. And I find that very interesting, and there's a very complicated discussion behind the scenes, which we're not going to get into. But it all has to do with how they, as an institution, figure out where their profit centers are at. And it changes constantly, and all of the branches are kind of doing it. And as we talked about it earlier on, the whole concept around the overnight rate and banks literally lending money to one another, that's been out of necessity because of the way that these monies move around. And when you think about it, banks have literally billions and billions of dollars in reserves secured against property or other assets. So, a minor hiccup, a 0.001% shift or mistake can end up being millions and millions of dollars to them and their bottom line, which definitely can have a negative effect on their shareholders, which is, not a bad thing that they're responsible for those types of things. So that's that, and that fits into what they look for. Some of the questions, just on a side note, I'm not going to go into this. I literally have a page of questions. But at the branch level, typically, not always, but the people that are actually having these conversations may not be digging down deeply at that particular time. And a couple I'd like to just to highlight, for example, a somewhat simple one is the property itself. So what type of property is it? Is it a single family home with or without a suite? Is it a duplex, triplex, fourplex, multi-unit? You know, those are all conversations. Not everybody understands, you know, what a fourplex is and what it looks like. And even today in Alberta, the rules are changing in the major centers. So, you know, there's some ambiguity with that, even within, you know, our space, let alone within, you know, the space of somebody at a branch level. Corporations. So holding a property in a corporation versus a private name. How does that impact things? Many of these folks that work there are, again, longtime bank employees. You know, sure, they understand what a corporation is, like they're smart people, but, you know, they may not understand the nuances of that inside of a real estate holding. And with that being said, is this corporation a real estate holding company, or is it actually a real estate operating company? And for the savvy investor, you'll know the difference, and you know the importance of making sure that, kind of like I've set up, you actually have both. you know, you want to be able to have money moving in and out of different corporations because of the tax implications, which is a whole other conversation, that can exist within the world of real estate. So they can be some pretty complicated conversations. And again, that's why it's so important to approach this from a strategic perspective. Okay. You guys tired yet? I'm tired. That's a lot of information. All right, let's actually talk about a couple of examples as we wrap things up. So this is just a few scenarios of things that we've stumbled across. So here's a great situation. Somebody owns their principal residence and they actually own 5 rental properties. So this is a great example that, you know, some of us would like to be at. They've placed all of their properties within one bank, a relationship that they've had for many years, and now they actually get to a place where they want to move past 5, let's say, or get into a commercial property, a multifamily unit property, and suddenly that big comfy couch is not so comfy because they're not really wanting you to do business with them in this space anymore. Subsequently, if you didn't set it up right from the first part, you're now going to go to another lending partner who's going to look at, you know, all of your debts and all of your income and say, you know what, your debt service ratios are like way out of whack. Like, yes, you have some great equity over here, but the cost to service that debt is so high, you have now become a bad risk for them. And again, there's strategies behind this that we don't have time to discuss, but that is why being very strategic with the way that you do your lender placement is so important. Because this is not a scenario that's uncommon. You know, sometimes it's not 5 rentals, it may be 3 moving to 5, but people find out pretty quick that they're essentially forced to access capital at a higher interest rate because they can't get capital at a lower interest rate. And being forced and making the choice to do so are 2 completely different dynamics. So just be aware of that. So goal, in their situation, it was actually to acquire 10 properties over the next 3 years, which in a market like today, as we've heard from our other speakers, this is a fantastic time to be adding properties to your portfolio, regardless of what your scenario is. There's a ton of people selling, and the market has reacted to that, and prices are down. So that's, you know, that's something that they're just not going to be able to actually do. In their case, there's some other thoughts they had about buying and holding some duplex or fourplex property, and they want to liquidate everything 5 years later. So again, cash won't allow them to do it because they just can't put that together. And even though they want to move into a retirement situation where their portfolio will actually bring them capital passively, they're not able to actually do it. So some of the things that we would actually work on with those folks, we would definitely look at this from a strategic lender placement perspective, even in their situation. So what we actually may do is we may actually start by looking at refinancing all of their properties. You know, let's pull some of the capital out of those properties and get you in a cash positive position. All of them, some of them, I referred to it earlier with blanket mortgages. There's some fantastic pieces of mortgage products out there that you can actually put a blanket over top of a whole bunch of products and kind of bundle it into one portfolio. In some cases, that's done within your personal assets. In other cases, it could be done through a corporation. So then, again, depending on where you fit in that mix, you could be entirely removed from the calculations that the bank would look at whenever they're assessing your debt servicing ratio. Then we would probably look at purchasing something, maximizing it, depending on what that would be, and ultimately get your goals, which is retiring and having a passive income stream based on your portfolio. Here's another example. As we learned earlier today, 20% of Canadians are self-employed. I actually don't know this number for Alberta, but I'm almost 100% sure it's higher than 20%. So because we've always been, the wild west of entrepreneurship out here, I would garner it's probably sitting close to 30%, maybe even a bit higher. Tons of people that I know that have worked in some of the different oil areas end up, they work for a large company for a while, they then get laid off. The work still needs to be done though, so then they get hired back on as a consultant. Well, that consultant is now a self-employed business person. So, those scenarios are happening a lot in Alberta just because of oil and all of things around that. So in this situation, the person was self-employed, they had no available cash, but they did have lots of time. So if you're a great candidate for wholesaling or assigning properties, and in this instance as well, they also had experience doing some of the work themselves. So a valuable combination if you're using it properly. Their goals essentially were to do some flips, to buy and hold some larger projects, and then using their professional experience to actually go into the world of development. This is so hard to do when you're not well financed. So again, some of the strategies that we would come up with is, let's find some private mortgage money to actually build your portfolio in a situation like we talked about earlier, where maybe they would find the projects, the joint venture partner would come in with the funds, they would work on that together, split the profits, and continue moving forward, either separately or together, depending on what the project is. Hard money for things like flips, for example. I'm involved right now with a hard money project personally, that they're looking for, they need money for about 6 to 12 months. My rates aren't unreasonable, but way more than I would be getting otherwise. And for me, it's awesome because I know that my money is actually working for me, and I feel that I'm very actively involved with the real estate market. Even though it's a very passive income stream, I'm still able to kind of keep on top of that. And in this case, they only need it for a short amount of time to finish development or a rehab essentially, and then the money that they make from the rent of this area of the home, which is no longer, it's now not generating revenue, will actually go towards servicing my debt and paying me off fully. So it's a win-win for everybody. And again, finishing up this, you guys know, I'm sure most of this, build capital, then you declare income. One of the major challenges that self-employed people have, and again, I've been self-employed since I was 15 in one way, shape, or form, we like to minimize the amount of taxes we pay the government. And that's not a bad thing. I'm not here in any way, shape, or form to promote tax evasion, but definitely using the taxation system to your maximum advantage is just a really good business strategy. But if you are looking at declaring income in order to get revenue properties, you're going to have to make some money and you're going to have to pay tax on that amount. So one of the things that we do, especially on a bit longer term scenario, whenever we're dealing with self-employed people, is we say, look, if you want to hit X goal in 3 years, your notice of assessments for 2019, 2020 need to kind of look like this. So be prepared that as you're generating money, you may want to put a bit more of that aside for taxes, because if you want the big plan to go round and round, you're going to need to have some income, which means you're going to have to pay some taxes, which means you have to prepare for that and plan for that. Most people, unfortunately, especially the ones that are new to this game, they don't ever think strategically beyond the next 30 days or 60 days, 90 days. So, and again, in a room like this, where there's tons of experience and people who are experts at what they do, I encourage you to draw upon that experience, to be thinking a little different time frame than maybe you were, and just to know that you need to be preparing for these things as you go. Okay, so where are we at? Oh, this is about me. So what do I do? Well, I like to prepare, package, and present your deal to a variety of lenders at no cost to you. For those of you who've actually worked with a mortgage broker before, you know exactly what we do and how we do it. There's really no difference in working with a mortgage broker than if you were working with somebody at your branch level as far as the steps of engagement or the rules of engagement. The biggest difference is, though, is that as a mortgage broker in Alberta, I have access to over 60 different lenders. Whereas most of the branches, when you go in, they're only there representing their mortgage products. So again, in some cases, there's some very good products from the lenders. There's some absolutely fantastic choices out there. But if you don't fit in their right box, and you're concerned about being capped, in my opinion, it makes way more sense to be looking at various options than to be kind of clustering everything in together with one particular option. And most people don't know this, or at least the ones who have never dealt with mortgage brokers before, but everything we do is at no cost to you. The lenders typically pay us a finder's fee, even with private money and the hard money lending. You know, we work within those situations, and we need to get paid for our time because you know, none of us like working for free. So that's something that we have to think about. I hate having to charge fees for my services to the buyers, but I also hate working for free more than that. So it kind of balances out in the end. But I will guarantee you that any of the fees that a good mortgage broker receives are typically passed on to you in long-term savings. So it truly is something that you get paid back on time and time again whenever you're actually dealing with somebody who's in this space, who understands what's going on. So, okay, so as I said earlier, I kind of let the cat out of the bag whenever I mentioned this before, but please take me up on this offer, depending on where you're at or where you're kind of sitting in that world. I know one of our speakers earlier today talked about bringing capital into a conversation and the numbers, you know, let's call it between $50,000 to $100,000. In some cases, if you're able to actually get together with some of your friends and family and maybe kind of on your own put together some pools of capital, you know, maybe you only have $5 or $6 or $10 or $4,000 to put into a deal. But if you are able to loan that out to other people at a 10, 12, 15% rate of return, you can actually use your money quite quickly to build yourself more capital. And again, whenever, as an investor and as a JV partner, I don't want to deal with 13 different people coming to me with, $2,000 each. But if you guys were all able to get together and to come to me with $26,000 and say, hey, we've got half of what you're looking for, that's something that I can then work with as a joint venture partner and say, yeah, I've got this other guy who also has $25,000 and that fits our, $50,000 minimum, and then we can kind of go from there. So there is a lot of ways to get involved with real estate. This is a great ebook that kind of explains it. It also talks about RSPs and TFSAs and a whole bunch of other stuff as well, so I'd highly encourage you to get a copy of that. And then last but not least, if you do want more information about your strategic financing options, I'm always available for a conversation. I love doing deals, and I love being part of a community where people are actually actively doing deals. My learning curve this last year has been literally vertical, and it's only recently where it's actually starting to flatten out a little bit, because once you understand the dynamics of the different deals and what financing for a rent-to-own looks like, or financing for a fix and flip looks like, or again a multi-unit or multifamily apartment building, once you kind of understand the dynamics, the only thing that really changes is the people involved. So that's definitely something I love, because I get to learn from you and your story, and at the same time I'm also always willing to share mine, and between all of that we can see if we can do some business together, and I'm pretty sure we can if you're interested in doing that. So that's it for today. Thank you very much for taking the time to be with me, and if you have any questions, by all means please contact me. Thank you.
No questions?
I need a drink of water.
So have you seen when the banks pulled out the mortgages out of the blue?
Out of the which, sorry?
Out of the blue.
Out of the blue.
I'm not getting your question.
Mortgages.
Yeah?
I have friends of our
Oh, like home mortgage.
Yeah, there is like those small prints, right? You cannot have a second mortgages. Have you seen them?
Yep. Oh, yes. There's a very growing amount of concern with people that are about to refinance their home, like their homes are up for renewal. This kind of 2018, 2019, there's I keep hearing different numbers. Some say as high as 60% of all homes in Canada are coming up for renewal right now. And I haven't heard any official number on that, but let's just say the numbers are very high. But with the changing rules that the government implemented in January and the stress tests, a lot of those people are no longer qualifying for the same way that they did before, as I mentioned earlier. But in that same conversation, I have heard where banks are kind of opening up those files 6 months before they're renewing in order to, again, aggressively market to those people, because the ones that they want to renew, they don't want them talking to a mortgage broker. And this actually happened in my circle twice this last year, where two of my very best friends who knew what I was doing and absolutely wanted to give me the business, we could not do a better job for them than what their existing lenders were doing because of the aggressive approach that they took with both of my friends. And at the end of the day, I'm very thankful I was part of the conversation. I would have loved to have been paid on that, got that information. But they should have stayed exactly where they were at with the offer that their existing lenders were giving them. But in that same conversation, those same files are being opened up, and people are actually, like the lenders are actually looking at those files and are now telling folks, hey, you know, the numbers aren't working. We need some extra equity, or, you know, at the end of this term, we're actually not going to renew. You're going to have to find alternate lending. So I haven't had any of those conversations directly with people, but I definitely have heard that it's happening in the marketplace, which is scary and a great opportunity, depending on which way you look at it. But I know if I was in that situation as a homeowner, that's a call that I would not want to get from my lender.
I will rephrase the question.
Okay?
Many times investors, they look into the second mortgages, and the primary A lenders, they do not allow having second mortgages on their mortgage.
Right.
Have you ever had any experiences with those investors having first mortgages pulled out because of that?
Not personally, no. But I do know it happens. And that's something that, again, just going back to the early conversation about partnering with the right people, it was mentioned, it was mentioned in every presentation today. You need to make sure that that you understand the fine print of any other financing that's on a piece of property that you are entering into an agreement with, because even as a passive investor, if you're lending that money and that home is then a piece of collateral, if your collateral no longer is collateral, then it's basically like a promissory note, and rates of interest for a promissory note with no asset attached are typically much higher than if you're in a joint venture relationship with somebody. So it's really important. It becomes like in my circle, because again, I haven't dealt with that a lot outside of this circle, but from my circle, that's where it gets pretty complicated, or at least you need to be very aware of it if you are doing something like an AFS, like where there's an existing homeowner with an existing mortgage, and then there's, let's say, a renovation that needs to take place, and then another investment partner comes in, uses the house as collateral. Those are the kind of more complicated files that I've been hearing about. But again, fortunately, I think, for me, I haven't had to deal with any of those. So
sorry, just to understand that, if you buy a mortgage product, it can sometimes limit you to say that you can't have a second one?
yes, with another lender. You can have a second mortgage with that same lender quite often.
Oh.
Actually, I think almost all the time. I could be wrong, so don't quote me. But a lot of the times, if you qualify, of course, a lender will give you a second mortgage on a property that you own, that you already have a first mortgage with them, typically always at a higher rate, of course. Because there's more risk. Even if it's the same lender and they have first and second position, there's always a bump for that second mortgage place. But yeah, often it's not allowed.
So is that particular banks that do that?
I'm going to say it's almost everybody.
So when would they choose to put that in, and when would they choose to leave it out?
The reason being is very, very simple, and correct me if I'm wrong, because they want to have a securities in case something wrong happens. And that is the fine print all the time, and it's not 1 year, 2 years. It's like for many years.
Yeah.
And the people which they invest in on a regular basis as a real estate investors, right? They are very cautious about the second mortgages, and they're looking for any other ways to make sure that they are creatively structure the deals, right? So working with mortgage brokers like Ron is very desirable to just make sure that you are not making those mistakes from that perspective, right? You know, like, you do not know what you don't know, but experience will tell you sooner or later that you can have a call-off mortgage, first mortgage, out of the blue because you put the mortgage, second mortgage. You know, they will not tell like, oh, okay, because you put second mortgage, that will happen right away. But in the case of the, you know, particular situations, they can call off first mortgage.
Well, and you have to think about it from their perspective, and I'm not,
Securities.
yeah, I was gonna say, I'm not defending the banks necessarily, but it's about to sound that way. If you have a property worth, let's say $100,000, just simple math, and you put in $20,000, they own $80,000 of that property. It's their money. Like, they essentially own the property. And they should be looking after their own investment because you have such a small percentage of the overall cost of that property. Where I think it gets people in trouble sometimes, actually a lot of times, and not so much investors because you guys get it, but whenever people, especially the 5%, the 10% down, they feel almost a sense of entitlement that, well, of course, you know, the bank should lend me, you know, whatever. Like, the average cost of a home or a mortgage in Alberta right now is $320,000. So, you know, of course they should lend me $320,000. Look, I put my, you know, $50,000 in, or whatever that number is. I'm like, and sure, we're kind of used to that, but mortgage funding is a privilege that we earn through, you know, our decisions in life, by having jobs that pay a certain amount, by taking, you know, paying our bills on time, and being responsible with the way we actually use credit on a regular basis. And our culture has kind of shifted in the last number of years, and I think it's only been with the mortgage rule change at the beginning of this year specifically, and there's been some changes over the last couple of years, but the stress test really stressed people out, because the government essentially said, we don't think Canadians can manage their debt load without us intervening to a certain degree. If you read between the lines, that's exactly what happened. Like, they're not saying that, and there's no published report, but that's exactly what happened. I literally, weekly, see, I get the OWL, that's another great resource if you guys don't get it, from ATB. There's like an email that comes out every day. Every week, there's new information from the OWL saying, Albertans, you know, their pay is going up, and this is going up. What was the last one? Restaurant bills are going up. And it was actually interesting because on one day they were talking about the amount of, like, the average bill at a restaurant, and they were saying, hey, people are spending money again because the average ticket price for a meal out is going up. Well, the very next day, credit card debt in Alberta at an all-time record high. I'm like, okay, you know, does nobody see the correlation here? Like, they're going out for supper more than ever, and they're putting it on their credit card. So where does that catch up with us? Well, it catches up with us here. This is where it catches up with us. So if we, as savvy investors and strategic ones, are able to say, you know, okay, you go out and have dinner 5 times a week, I'm going to do it twice a month, and that money that I'm actually not paying on interest, I'm going to, you know, sock away, so that whenever people start losing their homes, or when the stress test prevents people from refinancing their home because their renewal is up and they no longer meet the requirements because they have zero equity in their home because they spend all of it on their home equity line of credit with vacations and whatever else, that's whenever the shift really takes place. So, and we're going to talk about it, and actually I'll do it now. I have books for everybody who wants one. This book literally was the piece that really changed my perspective towards real estate, and literally, I don't want to be, you know, totally dramatic, but it changed the direction of my life. And it's called The 5 Wealth Secrets 96% of Us Don't Know. And it talks specifically about that. It talks about managing money as a tool for your ultimate goals in life. And it's a great story. It's actually written as a parable about a son named Isaac and his dad, and kind of like the rich dad, poor dad kind of thing, where, you know, dad was giving Isaac advice, and then Isaac was actually implementing some of those strategies. And lo and behold, you know, fast forward, Isaac in his 30s, you know, he's a hard money lender to his friends who spend every single dollar that they have on, you know, new cars and vacations. He owns a car wash and a small investment portfolio. He decides, he gets married with no debt and doesn't need to work anymore, and ends up, doing social service programs in other countries because he can just travel where he wants, when he wants, because after, doing this for 25 years, he has a passive income stream now that has changed his life and changed the legacy of his family. So anyway, that's this book. I highly recommend you read it. Everybody gets a free copy, and I would encourage you to pass this on to anybody else as well, because there's some fantastic real estate, simple real estate lessons that aren't directly real estate, but you can read very quickly how it completely relates to us and what we're doing as investors. So. Okay, well thanks for having me.
Great.